Hi there, I'm Edward Galstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Rockwell Automation, the US-based leader in industrial automation and digital transformation solutions. The big question is Rockwell a durable moat player in automation or just a pricey stock? We'll break down Rockwell using our 5 key factors. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, please hit like and subscribe. Now let's jump in. Great businesses start with efficiency. If a company can't earn strong returns, nothing else matters. Rockwell posts a 12.3% return on invested capital. When we compare this to peers, it is right in line with Honeywell at 12.5%. ABB leads with 14.7% and Schneider trails at 9.5%. So Rockwell is solid, competitive with Honeywell, but not at ABB's level. On equity returns, Rockwell comes in at 25.7%. Honeywell leads at 32%, ABB is at 27%, and Schneider is far behind at 14.6%. This shows Rockwell is highly profitable, but not the standout. ABB and Honeywell edge it out. Returns today are nice, but without growth tomorrow, the compounding machine stalls. Over the past decade, revenue grew at a compounded annual growth rate of 3%. Net income grew at a CAGR of 1.6% and earnings per share grew at a CAGR of 3.5%. Let's compare that to peers. ABB grew revenues at 3.5% and net income at 9.5%. Schneider grew revenues at 4.1% and net income at 13.1%. Honeywell showed flat revenues and 2% net income growth. Rockwell grows a little faster on sales than Honeywell, but its profit growth is the weakest in the group. Earnings per share growth looks modest, helped somewhat by stock buybacks. Even the strongest business model can crumble under weak balance sheets. Here's where Rockwell stands. Total cash and short-term investments at $0.5 billion, total debt at $4.1 billion, and a debt-to-equity ratio of 1.1. Free cash flow is $0.6 billion, barely covering 15% of total debt. Now let's compare this to peers. ABB and Schneider maintain far stronger coverage, with free cash flow to debt ratios well above 25 to 40%. Rockwell, like Honeywell, sits closer to the bare minimum threshold, leaving less margin for safety if cash flows dip. This is a financial weak spot compared to its European rivals. Even the best companies can be poor investments when investors overpay. So how is Rockwell valued today? Rockwell's price to earnings ratio is 40.5. If we compare to peers, ABB is at 31.2, Schneider is at 30.6, and Honeywell is at 24. So Rockwell is by far the most expensive in the group. Now let's adjust the PE for growth using the PEG ratio. Long-term analyst EPS growth estimate is at 9.6%. This gives us a PEG ratio of roughly 4.2. For context, Honeywell sits around 3.1, ABB is at 3.2, and Schneider is closer to 2. A PEG ratio above 2 already signals a steep premium. Rockwell at 4.2 is the priciest of the group by far. Does Rockwell have a moat strong enough to justify that premium? Rockwell is highly focused on factory automation, from the hardware that controls machines to software that monitors and optimizes production. This specialization makes it a pure play leader, and embedded systems create high switching costs for customers. However, the moat is narrower than peers. ABB and Schneider offer broader ecosystems and global reach, making their competitive advantage more diversified and durable. Now before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. Here's what our 5 key factors reveal about Rockwell Automation. Returns on capital are strong, with return on invested capital at 12.3% and return on equity at 25.7%, but not best in class. Sales growth of 3% is fine, but net income growth at 1.6% is the weakest among peers. Looking at financials, cash is thin at $0.5 billion and total debt at $4.1 billion. Debt coverage sits near the minimum. At a PE ratio of 40.5 and a PEG ratio of 4.2, Rockwell is the most expensive stock among peers. Rockwell has strong niche focus, but arguably not a wide moat compared to ABB and Schneider, who are growing faster and offer broader platforms. To wrap up, Rockwell is a focused automation leader with sticky customer relationships. But with slow earnings growth, stretched financials and the highest valuation, investors face a lot of downside risk if expectations aren't met. What do you think? Does Rockwell's premium price reflect a true moat, or is it an overhyped industrial play? Drop your thoughts in the comments, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.